Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com.
Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. A brief look at the metals over the last week. Gold currently, at time of recording, sitting at around $1,790 after breaking just above $1,800. Silver, $23.85, little bounce off a rising floor that we'll look at here in a second. Platinum continues to inch down, sitting just under $1,000 at $997. Palladium taking a really nice bump back up after losing about $600 an ounce, up to around $24.26. The U.S. dollar continues to show some strength, currently sitting at around 92.83, and the Dow inching towards another all-time high, saying that every week now, 35.4. So starting with gold, we are going to take a look at this bump up that we've had after that flash crash that occurred back at the beginning of the month, around August 5th, most of which occurred Sunday night in the Asian markets. Coming down to the long-term 618 fib for the third time now after the big rise that began last March 2020. It was nice to see that gold failed to put in a lower low and has bounced back up. Now, gold also would need to put in a higher high here and push at least above around 1840, preferably above 1916, which was our previous high May earlier this year. So gold continues to put in lower highs and lower lows on the long term since spiking at 2100 last year, or just under 2100. So until we start to see some consistency on the up end, gold remains in a short-term bear correction amidst a long-term bull market. And I said that slowly on purpose because all of those words matter in that sentence. What gives me optimism about the C wave increase in gold occurring at some point in the near future is the fact that the March, April, and August declines in gold all put in higher lows. Now, we've yet to see the higher high, but it is good to see that gold, every time it tries to go down, gold is incapable of pushing below a very firm line in the sand at around 1680. So with gold back up, flirting around the 1800 mark, we will certainly have to see if it's going to continue pushing up from here. I would like to see gold, like I mentioned, get above at least the short-term highs around 1840 and preferably push well up into the 19s. That's very reasonable coming into the fall season, which we talked with Robert about a couple weeks ago, and have shown over the last 10 years you tend to have these seasonal moves up in the fall and the early spring in gold. So we continue to be optimistic for the future of the gold price here over the next couple months. I'm excited to see what gold does here at this pricing. Could we see a higher high? And if we do, it would probably be within the next couple of weeks.
You know, the seasonal trends would support that. We've talked on this show often. In fact, this time last year, I remember putting up the metrics that showed the strength of the fall turn. So the close of the fiscal year, fourth quarter for the federal government going into September and October, November, those tend to be strong months for gold. And then we tend to taper off a little bit in December. And speaking of tapering, we're waiting to see what sort of price action gold gets tonight or tomorrow with the Fed announcements as they meet in Jackson Hole, Wyoming. Nothing to be reported yet. The meetings got thrown off because the in-person attendance was canceled and everything went remotely. So waiting to hear on that. And the news coming out, though, is that there's no expectation of any decision on tapering, which is why I said that. No ability to taper the Treasury and mortgage security buying. They can't do it yet. Still too early. Economy still too fragile.
Now, while gold has had this pretty aggressive decline and rebound off of the early August drop down to the lower end of the trading channel we just looked at, silver hasn't had much of a return back up. With silver also taking a decline from a little under 26 down to about 22, silver's only come up to just under 24. It's only reversed about halfway, whereas gold has almost made up all the ground it lost. So silver remains at the lower end of its rising channel. We've been talking about this rising channel since around September of last year. It's been almost a year. but it continues to emphasize that silver has yet to turn bearish at any point since we started going up in March. It has stalled, and the stall range is pretty massive. I mean, we're talking anywhere from 31 down to 22. But every major high has been higher, every major low has been higher, unlike the other metals. So one thing we've talked about for the last couple years here is the fact that silver needs to play catch up on these historic average pricing between silver and gold, silver and platinum, silver and the Dow, silver and anything you can think of. Silver has continued to lag behind, so it shows great strength and likelihood that silver will make that catch up, because while other metals are showing some signs of not weakness, but let's say respite amidst the bull market that we started back in 2015, silver continues to hold strong. Big trading range, but a positive trading range.
That's a really good point, and keep your eye on the ratio. If you're looking for the value and whether silver's doing what it should do, its bullish activity has actually given you encouragement, because this time last year, remember, we hit a high, well, it was actually about 14 months ago, we hit a high of about 125 to 1 in that gold to silver ratio. We creeped up this week to 77, almost 78. We're back down to 75, and that's on silver outperforming the gold. Gold has been strong here as of late, but silver staying strong in that, as you said, massive channel has actually brought us down from, remember, 120 down to 62. Now we're back up to 75. That's showing that silver is still undervalued, but it's doing what it should do, because the years leading up to that, remember that period of time, we were stuck in the 80s and even the low 90s on the ratio. So we've done so much better by being in silver with a portion of the portfolio, and it's not changing now. I think that this ratio comes back down into the 60s again before we see it go back into the high 80s.
Yeah, and a push back into the high 80s would bring, I think, silver buyers back out from the woodworks, right? I mean, a lot of silver buyers, when we were in the 80s, 90s, 100s, were really trying to load up on those positions at that time. And as we pushed down sort of to this median pricing, this median ratio between the two, over the last 40 years or so, I believe, is in the low 60s, high 50s. The expectation, obviously, is that the seesaw is going to swing the other direction. And maybe we see ratios down in the 40s or the 30s, which has only happened once in my career, but certainly possible again. So if we were to see maybe a second wind in silver, something around 80 or 85, a little bit of 2 steps forward from 120 down to 60, maybe 1 step backwards. I love my 2 steps, 1 step, dancing up and down the stairs. You can dance going back down the flight of stairs too. And maybe that push down into the low 60s, we pop up to 85. It gets you the opportunity to add a couple ounces to your silver position on the way down to 55, 50, 45, possibly even lower if we were to see those numbers again.
Yeah, I agree. What do you think about platinum and palladium and their relative price action?
Well, same thing with platinum. We're always looking for opportunity to add to ounces. The opportunity that we had in silver when it was 100 to 1, 110 to 1 against gold, we continue to have that opportunity in platinum. Platinum seems to be the last person to start the race, but probably percentage-wise the one who finishes the strongest. So platinum, for the first time during this entire short-term bear market that gold has had, while silver has stayed stable, platinum had been staying stable until the beginning of July. So we have had a decline. Platinum has taken a full step backwards, 50% retracement line, and we've double touched at that point here and currently still sits there, maybe about $40-50 above it. So platinum has stayed relatively stable. Now, the thing I like about platinum again is palladium also came down, but palladium bounced hard. Palladium came to the 50% line, down around 2,300, so it went from 3,000 to 2,300 between May and where we are today in August. Very quick, aggressive decline. Platinum has bounced hard, back up to around 2,480. I don't think that that is arguably a good place to enter the palladium market, but I do think because we've had this short-term bounce here over the last week in palladium, that adds an even stronger reason to pick up an ounce or two of platinum, and I think everybody should. Platinum's under $1,000 on the spot price, probably around $1,100 to buy an ounce. Palladium back up at 24.26. You do the math, that's about 2.5 times the price. So I do think here in the last week, good opportunity to pick up an ounce or two of platinum. And if, as Tori was talking about, we get a bounce in that ratio on silver up into the 80s again, really good opportunity to pick up some ounces in silver. Now, all this is predicated on the value of the US dollar, which is showing some strength right now. The dollar did manage to put in a little short-term higher high. We put in a high around 93 1/3 back in March and April. We've kind of compressed up into it, and it did just barely scrape above that, just shy of 94 on the dollar index, and has dropped back down but not put in a lower low. So the dollar remains short-term bullish. Gold remains short-term bearish. Silver stagnant. Platinum and palladium showing a little bit of downwards pressure. Now, anybody who thinks that the dollar is strengthening over time can certainly stop listening to this show at any point you choose. However, for those of us that don't believe the dollar is going to get much stronger, these short-term reversals in the dollar index, and again, that's the weighted value of the dollar against other currencies, these short-term reversals, all they're doing is providing opportunity to get rid of worthless paper and turn it into real assets. So we've talked about those real assets over the last year, everything from wood costs to housing prices to gold and silver.
That's inflation. And so look at where the dollar is right now compared to where it was when we put in the August low in gold. It's unchanged. But what gold has done since that drop is steadily climb, and it does that in predictive fashion over and over and over again throughout history. It is the canary in the coal mine. It's slightly predictive. It doesn't give you much time, but it's going to be ahead of the curve. What do you have going on right now? You have infrastructure spending conversations and discussions and votes going on in Washington. So the Senate passed $1 trillion infrastructure bill. It gets passed to the House. The House now has ballooned it to $3.5 trillion, and they're kicking it back to the Senate. So by September 27th, there's going to be a vote on whether or not to boost our spending and our debt by $3.5 trillion because there's not the money to pay for it. When you have the global reserve currency status, this is what happens. Unfortunately, you talk about some of the timber or lumber or steel or concrete prices, whatever. Yeah, we're feeling some inflation here, but guess what, folks? We export our inflation. And when you massively print our fiat currency, the fallout from that is not mild. It's literally destructive. It's poverty, it's pain, it's even death in the form of war because you get so many nations so fed up with us having the world reserve currency status and being able to print at will that's what ends up happening. Now, maybe you say, well, I'm going to ride this out. I like this wave. I'm not going to bet against the Fed. Okay, don't bet against the Fed. Ride it out with a portion of your portfolio, but you better bet against the dollar because it is going to go down even further. This chart doesn't reflect it. That's the US dollar index, and it makes it look healthy and it makes it look good. Well, it's not. And unfortunately, we're riding on an economy of debt, war, fear, control, and fraud. That's our economy right now. And we're playing the game or we're not playing the game. I'm choosing not to. What does gold do? It allows me to stop and get out of the game. Because how do you preserve your portfolio or your wealth independent of a system that's collapsing? Not only collapsing, because it is collapsing. It broke in September of 2019, but an immoral system. Gold is guaranteed income when you need it. And I'm telling you, you have got to make the adjustment to your portfolio because we're witnessing a change. I had this realization today that you have a Delta variant. Everything's been sort of driven off course, if you will, with COVID. Do you realize Delta means change? The Delta variant means change. Well, guess what's happening? We're seeing a change across the board. We're seeing a change in governance. We're seeing a change in our monetary system that broke in September of 2019 with the repo markets. They're scrambling. We're seeing a change in wealth. We're getting the biggest wealth transfer in the history of the world right now. And everybody's just playing along and buying into it and hanging out with cash in the banks and letting them do what they're doing. And it's not going to stop. $3.5 trillion. Don't look at the dollar index chart. Look at what your dollar is able to buy on a day-to-day basis. You feel it. You know it. That's why gold has gone up. It's going to continue to go up. And unfortunately, that's countered by bad realities of the monetary system, inflation, your purchasing power of your dollar, the weakening of your portfolio, and that's all before the equities markets have even rolled over.
Look at that M2 money supply chart from last week when we had Rob in here, where you just look at the exponential growth in the quantity of money that exists.
And it's fraud. Miles, it's perpetrated on money printing and money making on things that aren't even true. It's values of things that aren't even real assets. It's values of things like digital currencies and cryptocurrencies that aren't even real.
Right.
It's not real.
Well, the whole point of money is so that instead of I give you chickens and you give me salt, we put all our stuff into a general storehouse and we have something that's easier to carry around. That's the whole concept of where some type of median of exchange came from. So the frustrating thing about that is we live in a world that has an infinite amount of medium of exchange, exchanging a finite amount of goods and services. Now, if the goods and services available had exponentially increased equal to the available money that had exponentially increased, if those two charts were identical, then it wouldn't make any difference. We're simply increasing money to make available the increase in goods and services. But that's not how the world works, because there's only so many atoms and molecules on the planet that you can rearrange in different directions. So the whole universe is a finite existence. But we use an infinite way of trading finite goods and services back and forth. And it is incredibly frustrating, because I do agree with you that the dollar index is a pretty irrelevant piece of information, except it's not, because it deals with the real day-to-day transactions that people have to take.
It moves the markets.
Exactly. And it affects the average person who's buying and selling things on any given day, because most people can't look at a 20 or 30 or 50-year timeline and look at averages and make those decisions. All we really care about is, what did I pay at the grocery store today? And if today's grocery bill is half a penny more than yesterday's grocery bill, you don't notice. Or what's even worse is today's grocery bill is $10 more, but tomorrow's grocery bill could be $8 less than average. And then 6 months from now, the grocery bill is $15 more. And then 6 months after that, it's $6 less. So we see these variants up and down, and we think, well, groceries were cheaper last time. And it's like, yeah, they were cheaper, but that's only because they're variable. You know, we took 2 steps forward in the grocery price, and then we took a step and a half backwards. So you get this kind of oscillating price up and down, and it trends upwards naturally over time, but the average person doesn't realize it.
Yeah.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. Do the YouTube algorithm things, the subscribe button, the ring the bells, the pluses, the minuses, and most importantly, engage in the comments. We do flip through your questions, and we'll pick some out from time to time to go through. So thank you, as always, for joining us. If you've got any additional questions, you'd like to talk to Tori or myself or any of the advisors here at McIlvaney ICA, we can be reached at 1-800-525-9556. You can find additional info on our website, McIlvaney.com. We're also on Facebook at McIlvaney Financial or Twitter at ICA Gold. Thanks for listening, and have a great week.